Let's talk about the First Home Savings Account, the FHSA. It's an absolutely incredible tool for anyone saving for their first home. I mean, it's basically like an RRSP and a TFSA had a baby, just for home buyers. But here's the thing. There's one really crucial detail that a lot of people miss. It comes with an expiry date.
So let me ask you straight up. Do you know when your personal FHSA clock actually stops ticking? Because if you don't, you could be in for a nasty surprise with some pretty big tax consequences. And that is exactly what we are going to get straight today.
Okay, so the official government term for this is your maximum participation period. It sounds complicated, but it's not. Basically, a countdown starts the second you open your very first FHSA, and that countdown ends based on 3 different events. The key thing to remember is, it's whichever one of these 3 things happens first.
And here's the rule of thumb. Your final hard deadline is always December 31st of the year that the very earliest of those triggers occurs. So let's break down exactly what those 3 triggers are.
First up, the 15-year rule. Your FSHA has a 15-year lifespan, period. And the really important thing here is that the clock starts ticking the moment you open the account, not when you put your first dollar in. So even if it sits empty for a year, that year still counts.
The second trigger is your age. You know, just like with an RRSP, your FHSA has to be closed down in the year you turn 71. So if you open one later in life, this might actually be the first deadline you run into.
And the third trigger, this is the one that often catches people by surprise. It's connected to actually using the account. As soon as you make that first qualifying withdrawal to buy a home, a new clock starts. Your deadline is now December 31st of the next year. So, for example, if you pull money out in June 2030, you have until the end of 2031 to close the whole thing down.
So what happens when that deadline is creeping up and you still have money in the account? Well, you've got 2 smart moves you can make to avoid any negative tax surprises. Let's take a look at what they are.
Your first and often best option is to do a direct transfer into your RSP or a RRIF. This is a fantastic move because it's tax-deferred, meaning you don't get an immediate tax bill. You just seamlessly boost your retirement savings. Your second option is just to withdraw the money as cash. Simple, right? But, and this is a big but, that entire amount is considered taxable income for that year. So the choice really depends on your situation. If you're having a high-income year, that RSP transfer is a no-brainer. But if you really need the cash and you're in a lower tax bracket, maybe the withdrawal makes sense.
All right, enough of the theory. Let's make this really concrete. We're going to walk through 4 different real-life scenarios to see exactly how these rules work in practice. This is where you'll see the right way and definitely the wrong way to handle your FHSA deadline.
First, let's meet Amr. He opened his FHSA, had great plans, but, life happens. He never ended up buying a home, and now that 15-year anniversary is knocking on the door.
So, if we look at Amr's file, his trigger was clearly that 15-year anniversary. He opened the account back in 2025, which put his deadline at December 31st, 2040. What did he do? He made the smart play. Before that deadline hit, he transferred the whole $15,000 directly to his RRSP. And the outcome? Perfect. $0 had to be reported as income. That is a textbook successful transfer.
Next up, we have Sophia. She got into the FHSA game a bit later in life, and now she's approaching her 71st birthday, which, as we know, is one of those non-negotiable deadlines.
For Sophia, the trigger was her age. Her deadline was December 31st of the year she turned 71. She decided to just withdraw the full $10,000 as cash. Now, this was a totally valid move for her, but look at the tax outcome. That entire $10 grand had to be reported as income on her tax return for the year. It worked, but it came with a tax bill.
And now let's look at Pedro. His story is the perfect example of the FHSA working exactly as intended. He used it to buy his very first home. This is the dream scenario. So Pedro made his big withdrawal for the house in 2031. That started the clock, giving him a deadline of December 31st, 2032. But since he used the entire account balance for his down payment, there was nothing left. All he had to do was formally close the empty account before the deadline. The outcome is just beautiful. $0 reported as income. The FHSA did its job flawlessly. And finally, we need to talk about Jungkook. His story is so important because it's a cautionary tale. This is what can happen when you just forget, when you let things slide past the deadline.
So here's where it all went wrong.
Jungkook used most of his FHSA money in 2034, which set his deadline for the end of 2035, but he totally forgot that he still had $5,000 sitting in the account. Because he missed that deadline, the account lost its special tax-free status, and the government automatically deemed that leftover $5,000 as income for him. He got a tax bill just because he forgot. That's the painful penalty for not paying attention.
Okay, after hearing about Jungkook, you're probably thinking, right, how do I make sure that never ever happens to me? Well, the good news is the actual process of closing your account is super simple. It honestly is this easy. Step 1. Get in touch with your FHSA issuer. That's just your bank or the financial institution where you have the account. Step 2. Just follow their instructions. They do this all the time and will walk you right through their standard closing process. And here is the absolute best part. You don't have to deal with a mountain of government forms. Your bank will report the closure directly to the Canada Revenue Agency for you. There is literally no extra paperwork for you to worry about, which is a huge relief.
So, whether you bought that dream home or your life plans just changed, your FHSA has a limited lifespan. It's a powerful tool to get you started, but every journey has a final step. The only question left is, are you ready to take it and close out your account the right way? Because knowing your deadline is the first and most important part of getting this right.